Ladies and gentlemen, good day and welcome to the Q1 FY25 conference call of Shemaroo Entertainment Limited, hosted by Valorem Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. I now hand the conference over to Ms. Purvangi Jain from Valorem Advisors. Thank you, and over to you, ma'am.
Good afternoon, everyone, and a warm welcome to you all. My name is Purvangi Jain from Valorem Advisors. We represent the investor relations of Shemaroo Entertainment Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings call for the first quarter of the financial year 2025. Before we begin, a quick cautionary statement. Some of the statements made in today's con call may be forward-looking in nature. Such forward-looking statements are subject to risk and uncertainties, which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to the management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings conference call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. I would like to introduce you to the management participating with us in today's earnings call and hand it over to them for their opening remarks. We have with us Mr. Hiren Gada, CEO, Mr. Argo Chakravarti, COO, and Mr. Amit Haria, CFO. Without any further delay, I request Mr. Amit Haria to start with his opening remarks on the financial highlights. Thank you, and over to you, sir.
Thank you, Purvangi, and good afternoon, everyone, and welcome to our earnings call for the first quarter of the financial year 2025. Let me first start by giving you some key financial highlights, after which our CEO, Mr. Hiren Gada, will give you some operational highlights. For Q1 FY25, the revenue from operations stood at around INR 154 crores, which was flat on a year-on-year basis. EBITDA loss for the quarter was around 13 crores, and net loss was reported at approximately 17 crores. With regards to the new initiatives in Q1 FY25, the expenses amounted to about INR 8 crores, and if you were to adjust for this investment, the adjusted EBITDA loss from the existing operations in Q1 would have been approximately INR 5 crores. Digital media revenues for the first quarter stood at around INR 69 crores, up by approximately 20% year-on-year. Traditional media revenues for the first quarter stood at around INR 86 crores, which declined by around 11%. Now I would request our CEO, Mr. Hiren Gada, to give you the operational highlights for the period under review.
Thank you, Amit, and good afternoon, everyone. During the quarter, viewership of the entertainment category as a whole experienced a decline on both traditional and digital platforms due to IPL T20 World Cup and the general election. This shift led to many key advertisers reallocating their spends towards sports and news genres. However, we believe that advertising expenses on entertainment category are anticipated to recover later in the year, driven by festive season and improving rural demand. The company's margins were under pressure due to a combination of two factors. First is deferred B2B deal closures in the pipeline, and second is the continued accelerated inventory charge-off, a strategy which we have initiated last quarter. Our inventory has come down from 682 crores as of March 2024 to 640 crores as of 30th June 2024, which is a reduction of about 42 crores. However, these charge-offs are purely accounting in nature and do not reflect the monetization potential of the content library, its revenue, or the ability to generate free cash flows as far as the company is concerned. Excluding the impact of these charge-offs and deferred deal closures, the company exhibited healthy performance metrics on all counts. Moving forward, the company will continue to strengthen its balance sheet and focus on operational efficiencies to discover its intrinsic value. In our digital segment, Shemaroo continues to gain traction, particularly with our Gujarati content offerings. This quarter, we released 10 new titles, including movies, web series, and plays, expanding our content portfolio. Noteworthy premieres include the blockbuster movies Vash, Yuva Sarkar, and Lagan Special. On YouTube, Filmi Gaane has achieved the remarkable milestone of becoming the 23rd most subscribed channel globally, with approximately 69 million subscribers, reflecting our growing digital footprint and audience engagement. Our general entertainment channels continue to perform well, with Shemaroo GEC channels securing a viewership share of approximately 7.8% in the overall GEC channel. Additionally, our newly launched kids and youth channel Chumbak continues to do well and is gradually stabilizing. We are also excited to announce the launch of AI-powered games on Shemaroo Verse in partnership with Geometry. This strategic collaboration enables us to offer an enhanced immersive gaming experience to our users, showcasing our commitment and innovation and leveraging showcasing our commitment to innovation and leveraging cutting-edge technology to engage our audience. With that, I open the floor for the question-answer section.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Dhruv Mukesh Bajaj from Smart Sync Investment. Please go ahead.
Yes, sir. Good evening. Since I'm pretty new to this company, so pardon me if my questions are a bit repeated in the previous phone calls. My first question was that how much percentage of our overall margin fall is attributed to the accelerated write-offs of inventory versus delay in the deals that we witnessed in this particular quarter?
So, I mean, it works both ways because the delay in the deal availability would have definitely had a certain amount of impact. Right now, I am not able to quantify that because which deals will fall when we don't know. However, the broad indication I can give is the additional accelerated charge-off during this quarter was in the range of around 30-32 crores.
Okay, got it. 32 crores. So I was just trying to understand that basically how long do we feel that this impact will keep rising in this inventory write-off? Because earlier we used to make like 8 to 9% types of EBITDA margins. So, I was just trying to understand on that front. Yeah.
So if you work backwards, those kind of margins are available even now. It's just the additional inventory charge-off that is kind of hitting it. In fact, the operational performance this quarter actually has improved. In fact, the margin structure actually has been better. I would say that, and we have, just to repeat what we have said in the last call, is that in 2 years we expect that the inventory will be written off by about 40% from where it was.
Got it. So that is very helpful. I was just trying to understand that only. And sir, what is our planned spending on the new initiatives like OTT in FY25? Because I guess we spend around 100 CR in FY24. So any number on that front for FY25?
So I think so the number that you are mentioning is actually towards the new initiatives, which also includes broadcasting. We have never specifically given any number specifically allocated to OTT or broadcasting per se.
Got it. So how do we see that in this current year, or like if we can get some understanding on that front?
The budget for this year, I think we had shared it in the Q1. I don't remember, but I believe it was about around 60 odd crores.
Got it, sir.
60-65 crores.
Yeah. Got it. And then my last question was that how are we seeing the debt levels and interest repayment? Considering I was just looking at our balance sheet and our cash position doesn't look that huge while owing to the challenges that we are facing in the legacy business. Free cash flow generation has also been a little lower than the interest payment for the past 2-3 years, if I'm not wrong. So if you can give us some overview on the debt repayment timelines.
Yeah. So as we have spoken about this whole exercise that we began and in the last quarter, that to get the balance sheet correction in place, and the two parts to that, one is the accelerated inventory charge off and other is the accelerated debt repayment. And we have targeted that in 2 years we will bring down the debt by about 100 crores from the March levels where we were in March 24. So we were at what was it?
338 in the month of March.
Last reported we were at 338. So we may see some quarterly fluctuations around, but so June we have from 338 we have come down to about 324, which is a reduction of roughly about 13 to 14 crores. However, I would say that within quarters there would be fluctuations. Also, some amount of lumpiness would be there due to the B2B deal closure, because some cash flow would come out of those deals also. But we are fairly on track for this. We believe that we are fairly on track for this target that we have set out over the next 2 years period.
Got it. And this will be funded primarily from our internal accruals, right? Versus a fundraise.
Internal accruals. We have not raised equity in last 10 years.
Right. Makes sense. That was my question. Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Jyoti Singh from Arihant Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. So, sir, similar question as per earlier participant on the revenue side and overall margin EBITDA side. So, like as per our earlier discussion, you have mentioned like we will overcome this election and T20 World Cup thing, and partially will be able to do better. But again, we are on EBITDA loss. So I wanted your comment on that, and for the future visibility, if you can give us some.
No, Jyoti, I think just to reiterate, in case you missed the discussion earlier, we have, and in fact, even in last quarter we have shared this, that we have embarked on a exercise to correct our balance sheet through combination of accelerated inventory charge off and debt charge off. Now the impact of inventory charge off is on P&L, where there is an additional hit, and this was a number I was mentioning in the previous question also, which is in the range of about 30 to 32 crores, between 30 and 32 crores is the additional inventory charge off hit that we have taken against what would have been normally the expense. So to that extent, actually our profitability and margins are quite healthy. There is a non-cash accounting charge of additional accounting charge of between 30 and 32 crores on this account. So in fact, and as I shared on the earlier in my opening remarks also, that operational metrics for this quarter actually have been very good.
Okay. And sir, further, if you can guide us for the future reference, what are expectations for the upcoming quarter?
So while we have never had a practice of giving forward earnings guidance, but what we are seeing, definitely we expect that in the festive season and thanks to a decent monsoon, we are expecting the rural demand also to revive and kind of steadily grow back, and festive demand-linked spend. So both of this we expect that to fructify around the festive season, which kind of starts kicking in, September, October onward. So that we are expecting that to be reasonably strong. And secondly, on the operational front, we have kind of been operating on a very tight and strong budgeting, and I would say working on improving the efficiencies strongly. So both these combinations, we are expecting that the operational performance and operational metrics will continue to we are hoping that they will continue to remain strong.
So let me just add one more thing to Orgo here, is the fact that, as Hiren said, we expect the advertising spends to improve in festive and beyond. And also, again, we mentioned it in the previous answer, is that there are some B2B deals in pipeline for closure. That also, once it closes and fructifies, that also will come to hit the revenue lines in the future quarters.
So, sir, Q2 will be decent for us comparatively Q1.
I can't say Q2, but I'm saying over the next 3 quarters, we would see those deals fructifying. And festive, as Hiren was saying, festive is basically October, November, because Diwali is on the 1st of November. So the last part of the festive revenues will happen in October, which is actually in Q3.
Okay, so basically second half will be better for us.
That's right.
Okay, thank you so much.
Thank you. Ladies and gentlemen, just a reminder, anyone who wishes to ask a question may press star and 1 on the touchtone telephone. The next question is on the line of Yash Kukraja from Equity Capital. Please go ahead.
Yeah, thank you so much for the opportunity. Am I audible?
Yes.
Okay, thank you, sir. So my first question is, what is the current status on the launch of new channel, and how are our existing channels performing? Like, have we reached break-even levels, or how long will it take to achieve that? So this is coming from, given that our revenue has been almost around 150 CR for the past 8 quarters, except 2 which we had B2B transactions. So first question is that.
So let me try and answer that, Yash. In terms of new channel launch, we as we said in the last call also, I think we are in the process of evaluating, and the process of evaluation continues. We will see how the market opens. We are basically ready from the back end, but when to press the green light is something that we will see as the market evolves. We are not, that is always in the pipeline, but we will take a call as the year moves on. In terms of performance, I think Hiren mentioned in his opening remarks that the 2 GEC channels are at about 7.8% share, the viewership share in the first quarter. This is also an increase over the last year, same quarter at this time. So they are doing well, and the new channel which we had launched last year, the Chumbak, the kids and the youth channel, has also grown steadily and is very gradually stabilizing. So that's how the channels are performing. We are seeing decent traction for our shows and the various initiatives that we're taking. But at the same time, as Hiren had pointed out, we have been very prudent in the way in which we have costed and budgeted for our shows and so on and so forth. So the channels are doing well. In terms of profitability, that's something which is, we are in the process of continuously launching new shows, and it is a gradual process. In terms of profitability, we have answered this question multiple times in the last 3 quarters. It's an ongoing process, and things are going as per our plan, is all I can say right now.
Okay. And sir, could you provide some insights into the quantum and frequency of this B2B transaction?
The quantum is something which we cannot say, because it depends on deals and so on and so forth. But normally these transactions are very lumpy in nature, Yash. Okay, so sometimes it all happens in a bulk. It may happen in 1 quarter, it may happen over 2 quarters. But as we are seeing now, we are in advanced stage of discussions. In fact, very close to closures. But closures take its own time because it's multiple agreements and so on and so forth and all that.
Yeah, there are a lot of process part of the documentation.
So, you could cross a lot of T's and put a lot of dots in the I's and all that. So there is a lot of process involved. We are well and truly on top of it, and we should see some reasonably good closures towards Q3 and Q4. Because we are already in August, we are almost entering August. So I think towards Q3 and Q4 we should see some reasonably good sized closures. Quantum we cannot say because it all depends on the.
Okay, got it, sir. And my last question is, sir, I have one bookkeeping question. Could you provide the operating cash flow figure for Q1?
We'll get back to you on that.
Sorry, sir, couldn't hear you.
Yeah, we'll get back to you on that.
Okay. Thank you so much, sir. Thank you.
Thank you, Yash. Ladies and gentlemen, just a reminder, anyone who wishes to ask a question may press star and 1 on the touchtone telephone. The next question is from the line of Pradeep Rawat from Yogya Capital. Please go ahead.
Yeah, good morning and thank you for the opportunity. So I'm pretty new to the company and I have one basic question. So what do we have in our inventories and why the inventories are being written off right now?
Okay, two parts to the answer. One is, of course, you probably need to study the company a little more deeper to understand why and all of there is some history to it, which I'll try and summarize it. But we can, if there is a longer answer needed, we can probably take it offline later. But yeah, so the inventory is basically all our film IPR or all the content IPR copyrights that we own. So all the Bollywood, the TV shows, the Gujarati content, Marathi, everything, all the content copyright, that's primarily 98% of the inventory would be that, or probably 100% of the inventory would be the film copyright. So that's our formidable library, and that is yielding us cash flow on a daily, weekly, monthly, yearly basis because we monetize that across different platforms. So the short answer to the charge off and all of that is that, so during the build up of the digital consumption era, so when the digital ecosystem was kind of growing, and prior to that or in anticipation of that, we have invested significantly to shore up and build our overall content library so that we are ready for the monetization when the digital era kind of unfolds. And this is an investment. In fact, we did our IPO for that. We raised debt and various things. It kind of came in as a stock. Now this stock is extremely valuable. We believe the value of the stock is significantly higher than the book value because the new monetization streams have opened and there's a long tail monetization that is available. However, the feedback we kept getting from a lot of investors was that in relation to the scale and everything, that inventory is on the higher side and so is debt. So we decided to kind of relook at the whole financial gearing of the company and the balance sheet and see how we can fix that so that we are able to unlock value. Now, all of this doesn't have any impact. It's purely an accounting this thing because the charge off that we do has to go as an expense to the P&L account. And so there is an additional expense every quarter that we have kind of taken on as a part of that. And the charge off has no correlation to the monetization potential of the content. It has no correlation to any of the business operations or the cash flow generating ability of the company or of that content, and to the value of that content. So that is, in short, I try to capture the answer. If you want a longer answer, we can take it offline.
Yeah, thank you for explaining in so much detail. So I have a follow-up question on that. So while we are acquiring IPs or copyrights, so what kind of ROI do we have in our minds before acquiring them?
Typically, at the time of acquisition, we look at an 18% IRR.
Okay. Thank you. That's all from my side. Thank you and all the best.
Thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1. Just a reminder, participants who wish to ask questions may press star and 1 on the touchtone telephone. The next question is from the line of Yash Kukraja from Equity Capital. Please go ahead.
Yeah, thanks for the follow-up question. So my question is regarding, as you mentioned, the accelerated inventory for this quarter was around 30 to 32 CR. So my question is, will this be handled linearly, or do we have a different strategy for writing off this inventory?
Sorry, could you please come again?
I didn't understand the question.
Yeah, so sir, as you mentioned that the accelerated inventory write-off for this quarter was 30 to 32 CR, correct?
Yeah.
Yes, sir. So will it be handled linearly while in the following quarters, or do we have a different strategy for this write-off?
So this 30 or 32 crore was for the quarter that went by. For the subsequent quarters, there will be some additional charge?
No. So I'll tell you, there are two parts to this. One is that the charge off in a given quarter, so there are multiple parts to the inventory. There is one large block of inventory where we have put like an equated charge off on a quarterly basis. But there is some other inventory which is linked to some event or sale or telecast or release or those kind of things. So this 30-32, what we are saying is, what in this quarter, as per our earlier method of charging off and this, what would have been the difference between these two is roughly in that range of around 30-32 crores. That may not necessarily hold true in the next quarter.
Okay, got it. And sir, could you explain a little bit on what is the major contributor in the operating expenses?
Major contribution is towards the amortization of or the charge off of the inventory only, and there will be distribution expenses for broadcasting.
Okay, got it. Yeah, thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Dhwani Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, everyone. So first question related by is that this accelerated inventory charge off. If you look at historically, essentially from accounting terms, it means that currently the profits are higher than what is reported because it's an accelerated charge off. But at the same time, historically, because they were not charged off at the right rate, the profits were inflated. So going forward, so essentially what we are saying is that we are charging off inventory today at a higher rate, right? So and you say that there is no economic rationale for that because in your view, the value of inventory is much higher than the book value, right? So it's the accounting treatment, right? That's the point that we are trying to make. My point is that now we are doing it from accounting perspective. That means that earlier whatever revenue that we booked against that we charged off certain inventory at certain rate based on the accounting principles.
Dhwanil, I really don't agree with that thought process.
Okay.
So,
okay. So can you explain, how should we look at? See, it's not about past. I am asking is that today, whatever content that you acquire, right? How do we ensure that the charge off of that content is in line with the economic value of the inventory used? What is the principle that we are using so that this kind of situation doesn't happen in future?
Dhanil, this is not a situation. I think, Dhanil, is a wrong way of approaching this whole this thing. We have looked at it more from a positive perspective. You are looking at it from a negative perspective. I really don't agree with the approach, firstly. And I would like to correct the understanding in the following manner. Please understand one thing, that the content that we have, has a really long shelf life and monetization value. Now, where and how this monetization, at what pace it will keep growing is anybody's guess, right? How much the consumption of a particular content will yield, or what is the revenue it will yield, is anybody's guess beyond a point. We can estimate maybe the next 3 to 5 years, but beyond 5 years, how it is going to be is nobody's this thing. What we have experienced is that as the technology and reach of entertainment has increased, so as the consumption and monetization expanded. Okay, and our policy, which was there earlier, was exactly in line to capture that. Now, even within that policy, anything that we owned perpetually, we were charging off in 10 years' time. Right? If you remember the
earlier. No, I am aware about that part, yes.
Yes. Now, does it mean that after 10 years that content is not going to yield anything? That content is going to yield, continue to yield beyond 10 years. Okay. And therefore, if I would have even charged it off over 15 years, it would have been justifiable. We didn't do that. We just charged it off within 10 years. Now what we are saying is, instead of 10 years, we will charge it off in 3 years.
Right.
Okay. So does it mean 10 was wrong and it inflated the profit? It didn't. All I am saying is that we have decided that, so we were always, because this feedback we got from last about 2-3 years additionally on the inventory. So we always kept our own comfort to carry the inventory and stock at this level was always high, because we knew the monetization potential always kept growing, and what was the monetization potential of that library. However, when we looked at and collated a lot of the feedback, we all took a collective decision that this inventory, let's swallow a bitter pill for 2 years time, and let this whole overhang, which a lot of people think of, so in relation to the scale of the organization, etc., it's suppressing some ROI ratios, or growing inventory turnover is, your churn is, or number of days is too high, etc., we thought that let's kind of bring it down to what the overall investor community will be more comfortable with, and that's the exercise we are doing. This is not at all got to do anything that charge earlier went was overstated or under reported or those kind of things. I like to differ on the
no. So my question even by is more towards the future, right? That today what we...
But when you start the question from that, the question itself, goes into a long direction. That was my concern.
Okay. So again, coming back to the future, right? Whatever we acquire today, how do we charge it off? Let's say we acquire some content for 100 rupees. Do we charge it off in 3 years, 4 years, 5 years? What is the policy on the accounting side that we are using?
So, it's based upon what kind of content we are acquiring. If we are acquiring a negative rights, again, it would be charged off over kind of a 2 cycles kind of thing. So, and with respect to digital, it would be around 10 years if it is a longer period one. So, and if it is a shorter period, then it is a 5 years.
Okay.
that way. So it's different and it's based upon the useful estimated life of the asset.
Yeah.
Okay, got it. Second question, I think to Argo is that, I think we had aspiration and we still probably have aspiration of reaching 15% of market share as it was once indicated in one of the presentation. But we have been hovering around this 7.5 to 8% market share for some time. And I understand, I think there is some recalibration happened and that has some impact on the overall percentage. But given where we are today, how do we see the journey from here to, let's say, reaching double digits or higher number? And, are we seeing any increase in our effective rates or realizations? Because the increase was to come with some lag. So, what is the status on that?
So, again, let me just, you are right. We are in that range of 7.5, and so on and so forth. But there has been a increase in the shares in this quarter compared to this time last year at the same quarter. Are we fully happy with the way it is right now? This is as per our plan. Remember, we had said that we will be very prudent while we have the aspiration, and the aspiration still very strongly we have, of reaching double-digit shares. I don't know where the 15% came from, but yes, we really wanted to be on a double-digit shares, and we want to go up to that 15% also. But the fact that, at least in this quarter, our budgeting was we were very mindful of the budgeting in terms of how many shows to bring in and all that, because we knew that in this quarter there will be headwinds around a lot of activities which is outside the entertainment category, which is in terms of IPL, T20, and also the general election. So, yes, our objective is to reach that share, but it is also to reach it in a profitable manner, in a manner that we can sustain ourselves. So, reaching that kind of shares would mean that, increasing number of shows and so on and so forth, but that also needs to come with the adequate amount of profitability. In terms of ER, I think the ER, as I have said in many calls in the past also, ER is a function of the demand in the market, right? One is obviously your rating and your standing in the hierarchy of the channel, but it is also a function of the demand in the market. And the ER has been growing steadily. I'm not in a position to tell you what the number is. The ER growth has been in line with the ratings growth, and we are happy with the way the ERs have moved. But as the demand keeps picking up further and further in the months of festive and beyond, we hope to see the ER trends continue and reach a level which we are comfortable with. So that's all that I can say right now on the ER. It's on a very healthy growth trend as per our plan.
I would add one more point that so we had set up the sales team about roughly you can say 3 quarters ago, and in 3 quarters the sales team has significantly stabilized and is now so our client counts and all other operating metrics are on a extremely healthy, in fact, on a high, literally on a month-on-month basis.
Yeah, I think that is one important point. Thanks, Dhiren, for reminding that. I think one point which is, while I know that a lot of questions comes on ER, but I think one of the more important metrics on ad sales in TV in broadcast is the number of clients, the client count. And we are at a very, very healthy level compared to our relative standing. Also, we are over-indexed, I would say, on our client count numbers, which is a very healthy place to be in. And as Dhiren said, 3 quarters of the sales team are coming. It takes its time to stabilize, and we are very, very sure that we are on the right track as far as ad monetization on broadcast is concerned.
Okay, great to hear that. And last question on the.
Mr. Dwanil, you may.
I'll come back in the.
Thank you. The next question is from the line of Anumesh, an individual investor. Please go ahead.
Hello.
Yeah.
Yeah. So again, the quarter is not consistent as far as the profitability is concerned. So I have two questions. First is the accounting policy regarding you were discussing some.
Animesh, your line is not clear. I'm not able to hear you.
Yeah, can you hear me? Hello.
There is a lot of
static
behind you.
Now can you hear me?
Okay,
Hello?
let's try. This is better. Let's try.
Yeah. So two questions from my side. First is the accounting policy we have been following now. It is for you were saying that we are discounting the expenses in 3 years, amortizing something like this. So it is in line with the other peers. First question is this, and second question is the revenue. I know it is not in our hand, but as far as the operational cost and expenses are concerned, we are not in the cash profit. So why can't we just have a control on the adding inventory and putting some efforts to have some profit in our books of accounts?
Animesh, I think you've probably either joined late or you missed the context of the call, but I'll just repeat. Our inventory has actually come down. Okay, we've not added. The inventory has come down from 682 to 640 crores. First.
Fine.
Number two,
so still we are in a loss, right?
That's because there is an additional approximate 30 or between 30 and 32 crores of additional charge. If you
so it is in line with the peers. That is what my first question is.
So unfortunately, intellectual property is something that is. There is no benchmark available or no accounting.
There is no
accounting standard available. That's unfortunate, and different people follow different policies. We used to follow a consistent policy for more than 15 years, 15 to 18 years. We have followed that. We just in last quarter we have decided the accelerated policy, and therefore that additional charge has come in.
Fine. So one more thing.
One more point which you mentioned about cash loss or anything. Actually, the debt has come down by nearly 13 to 14 crores. Now that cannot happen if there is a cash loss. If there is a cash loss, the borrowing would go up. So just to kind of indicate, so all the operating metrics wise, if you see, there is a strong performance actually in this quarter, underlying performance. It's this additional non-cash charge off which has kind of change the picture.
Okay, perfectly fine. And one last question is, I have just gone through that we have added, we are also part of the Geo, Fiber and other platforms, right? So my question is, do we get per subscriber revenue or it's a lump sum basis, yearly, quarterly, monthly, whatever? Can you explain? What the metrics we follow?
Unfortunately, I am not at liberty to talk about any specific deal because of various non-disclosure, clauses that.
So not for the company side, in a general, whether do we charge on the subscription per subscriber basis or? So
there are different models at which in which we work, and there is no specific any transaction based. That okay, we do this with this or this with that, but there are different models. So there could be a lump sum number that is arrived at, which is normally arrived at based on estimation of consumption, subscriber base, etc. All of that. There could be a per user number. There could be a consumption based number also, that how many hours of content has been consumed. There could be a ad linked kind of number. There could be different. There are at least 4 to 6 different commercial models that and each platform works differently. And we partner with virtually every platform where entertainment is served.
Yeah. That is noticeable. And are those contracts for a longer period, or it is renewable every year or two or something like that?
Typically digital platforms, our deals are between 1 and 3 years, not more than that, because the space is evolving and growing in different speed. So what is relevant today may not be a relevant price or commercial model 2 years down the line. Television is a much more stable platform, so we typically license our movies, and that's again a trade practice. The industry licenses movies for 5 years at a time.
Okay, perfect, Brian. Thank you so much. All the best.
Thanks.
Thank you. The next question is from the line of Pradeep Rawat from Yogya Capital. Please go ahead.
Yeah, thank you for the opportunity again. So I have a couple of questions with respect to our cash flow. So how much free cash flow do our current business generate yearly?
So, Pradeep, this would vary year to year because one of the major swing factor for cash flows is the B2B deals.
Yeah, on a
We
sustainable
are expecting for next 2 years, since we have committed a repayment of 100 crores, we expect around that much to be generated in next 2 financial years.
I'll try and answer it in a slightly different way. In the last 3 to 4 years, about 4 years I would say, we have invested about, so we have a couple of new business initiatives, which is the TV broadcasting business and the Shemaroo OTT app. And if you see our, every quarter we share what is the net investment that we are making in these businesses. If we look at net of that, each of the last 3 years, we have been generating about probably about 50 to 60 crores free cash flow. However, we have been investing a little more than that, because of which, so typically we've been in, whatever our investment need is there, around 75% is funded through internal accruals and 25% through borrowing, which is something that in the last quarter is what we have changed, and we said that we will be focusing on accelerated monetization and accelerated charge off. And as a result of that, we are aspiring to repay about 100 crores of debt in the next 2 financial, as in 24-25 and 25-26. So roughly you can say that is the broad amount of free cash flow that is being generated.
Yeah, understood. And my second question is with regard to our leverage. So are we planning to bring down the leverage with internal accrual only, or are we planning
internal accrual?
Yeah. Okay. And my last question is regarding our gaming collaboration. So what could be the future potential of this, and are we looking to expand further into the gaming industry?
Pradeep, this entire gaming and this metaverse industry is in its infancy. It's in a very infancy stage. We are part of it purely, largely from a futuristic point of view. There is right now we do not see any in the immediate future we do not see any major monetization potential there. However, there could be a lot of possibilities opening up in the future. And what we are doing is investing just enough to be future ready. We do not expect any returns right now, but we are just keeping this entire thing alive. And from a future point of view, this is something what we have started with in this new collaboration is something very interesting, where people can go into a site and play games, AI-powered games using our iconic characters. This is just a start. We are part of this entire process, and we will see how the world evolves. Right now it's very difficult to comment how it will pan out in the future, but we definitely have a hope.
I would clarify here that this is not some entry or plan to get into the gaming business. This is more driven from the Web 3.0 metaverse and future of how the whole web internet ecosystem itself is moving. So this is a part of that initiative. If you read last few quarters, we've been doing different partnerships with people like Sandbox and many other partnerships we've announced over the last couple of years, which is all part of the overall theme. of being future ready with the move of technology.
Yeah, understood. Thank you.
Yeah.
Thank you. That was the last question. I now hand the conference over to Mr. Hiren Gada from Shemaroo Entertainment Limited for closing comments.
Thank you all for participating in this earnings call. I hope we have been able to answer your questions satisfactorily. If you have any further questions or would like to know more about the company, please reach out to our IR managers, Valorem Advisors. Thank you and see you next quarter.
On behalf of Shemaroo Entertainment Limited, that concludes this conference. Thank you for joining us, and you may disconnect.